Good morning and welcome to the second in this webinar series on building a client base out of wholesale, high net worth and not-for-profit clients. On Monday, we heard a very interesting presentation from David Andrews of Capital Partners, Paul Ashworth of Cameron Harrison about wholesale and not-for-profit. But today we're going to focus on another part of the non-personal client base. We're going to talk about not-for-profit clients. The series is moderated by Greg Miller, and I'll leave it to him to introduce our two presenters today. But before I hand over to Greg, I just wanted to say a little about Friday's session, which really tries to draw together the threads of Monday and today in a business strategy sense. What is the strategy for an advice business that wants to build a significant client base from these non-personal clients? We'll have John Barton from MGD Wealth and John Woodley from Fitzpatrick's talking about business strategy for this client base. Now, before I hand over to Greg, let me just say a little about the Advisor Roadshow in May, Brisbane, Melbourne and Sydney. What we try to do with the Advisor Roadshow sessions is draw together issues around the business of advice. How do you run a better advice practice? And you'll see on the list of topics on the screen, how to transition to a managed account program, communicating with clients, a critical task, thinking about new business models, which of the various emerging business models for advisors is appropriate for your practice or your license. And one of the sessions will be presented by Findex, Greg Barter's organisation, on why larger practices prefer MDA as a structure for managed accounts. So I'd encourage you, if you're in Brisbane, Sydney or Melbourne, to register for the roadshow for May. But now, without further ado, or let me just mention, this session should be interactive, so if you have a question, down at the bottom of your screen, you'll see the Q&A button. Type that, Greg will see your questions and moderate them. So now, without further ado, let me hand over to Greg Miller, our moderator for today and this whole series. Thanks, Greg.
Thank you, Toby, and welcome along, everybody. Looking forward to this afternoon's session. So first of all, can I welcome our guest, Alex Pikoulas, who's the Chief Investment Officer from Lipman, Burgon and Partners, and Greg Barter, Senior Partner in Findex. Both come with many years of experience in this market and have quite a few not-for-profit clients. And so, as Toby said, happy to take questions as we go along, and I'll look to try and weave those in and get those through into our two experts here. Look, to kick us off, Greg, I might start with you and then go to Alex about, in this market, what really makes a not-for-profit client so different to your normal retail or ultra-high net worth client?
Well, typically, I guess the fundamental is you're dealing with a group of people who are the decision makers rather than a couple. And so I think from that point of view, and that group tends to change quite regularly. So if it's a committee or a board who you're dealing with, you have to be conscious that while you might have agreed on the goals and objectives with the client, if there's different people on board or different players or key stakeholders who are involved, they will bring new ideas and new ways of thinking. So you often have to go back a lot to reinforce what you originally decided was the investment policy.
Okay. Alex, your views?
Yeah, I think the basis of what you're trying to achieve or what you're advising on is similar. I mean, you're advising them on how to invest their money to suit their objectives. So that's similar, but then the process of doing that is, there are some significant differences. And I think the biggest one is governance. And it's because, as Greg said, you're advising an organisation, not an individual, and you're advising someone who is not the asset owner. So governance becomes a huge part of that role. And then there are other things that I think have greater emphasis on them, like liquidity management and potentially ESG as well, in terms of things that you need to think about. They're things you would think about in any case for an individual, for any client, but they probably need greater focus when you're advising not-for-profits.
Yeah. So governance might be one of them, but what are the sort of common issues that confront not-for-profits that you find when you come to them? And because you've got quite a few not-for-profit clients, what are the common issues that come up for them when they're trying to figure out which way to go?
If I could start, I'd say the common issue, or maybe common problem, is if you don't have the discussion with the organisation early on about what their objectives are, and make assumptions, then you'll sometimes have problems downstream. So I think Alex has said this previously, but I think making sure you've got a clear instructions, and plus they'll need a lot of guidance to help them set up what their goals and objectives are. And the other thing is how much risk they're willing to take to achieve their objectives, because generally you would think perpetual entities could have the capacity to take a little bit more risk, but the reality is that there's often risk aversion when you're dealing with fiduciary responsibilities. For, as Alex said, it was not your money, and so I'd say setting the goals and objectives from the get-go, but having a clear understanding of the risks they're prepared to take are important steps from the beginning.
Yeah. Okay. Thanks, Alex.
Sorry, I was just trying to unmute. Yeah, look, I agree with that. I mean, I think at the end of the day, because governance is such a big issue when you're dealing with an organisation rather than an individual, it's the investment policy statement first and foremost that is critical to get right and to get agreement upon, so that, as Greg said, it brings everyone on the same page. Because one of the big differences when you're dealing with an organisation rather than even a family is that you've got multiple different stakeholders. So in a family you do, but they're one family unit. They're probably more aligned in a family, or potentially more aligned than with an organisation. So I think the investment policy statement really helps bring everyone onto the same page and articulate really clearly what the objectives are of the wealth management piece for the organisation, and then you know what the targets are, who's got what responsibilities, and you've got a plan, to stick to. And I think that's really critical, and the number one area where you can have problems if you haven't got everyone on the same page. And as Greg said in his opening remarks, when you can have change in the people that are sitting on the board of a not-for-profit organisation, the constant piece can be the investment policy statement. That doesn't change. Well, it may evolve over time, but it probably won't change as often as the board members of the not-for-profit can. So that can be a way of having some consistency over time as well.
Is that a real challenge that you guys face? Is that because of turnover and new people come in, that it's a constant challenging maybe around that investment philosophy and what the real objectives are, and so you get pulled by different people as they change?
I think, Alex, the words you used were it's the constant, and it is, because often if you have new stakeholders come in or decision makers coming in, they'll have their own ideas. But if you refer back to the policy, as long as it's thoroughly been worked through and produced, then it's a way of keeping everyone on track. Because often when market's going really well, the board will be complaining about why they haven't got higher returns than they're actually getting. But then you refer to the investment policy, you should have told me, because you told me to get these returns, which is what we're doing. And then conversely, if you have a a difficult period and markets are drawing down, you'll often get a little bit of pushback from the decision makers. But if you can draw them back to the investment policy to say, well, this is what we said we're going to do and we're doing it. If there's violent disagreement, then maybe it's time to review it. And I'll be interested to hear what Alex says about how do you take the not-for-profits through when you're building that investment policy? Do you have a templated process you use, or do you let them come up with their policy?
Yeah, I mean, we don't have a formal template, but we've been through that process a number of times, well, both with not-for-profits, but also we encourage families to put investment policy statements together as well. It's because in any situation, I think where you've got multiple stakeholders, you really need that so that it's very, very clear, because otherwise you're just opening up to, disagreements, as you say, when in extreme environments, either to the upside or the downside, you're going to have different people wanting different things. And if you've got a clear policy that was agreed to by everyone, then you can always refer back to that and say, well, hang on, this is, this was the process and the policy that we all agreed to at the beginning. So we don't have a template that we run through with them, but I guess, from the experience of having been involved with organisations, there are standard things that we encourage them, or standard things we encourage them to think about with regards to the investment policy statement and putting it together. But it is very much a policy statement that the board needs to have buy-in on, because they are the fiduciaries. You're advising them on the wealth piece, but they are the fiduciaries of that organisation in the board, and so they have to have buy-in. Otherwise, you're going to end up in a difficult situation, being their advisor if they haven't got buy-in to what you're doing for them. So I think it really needs to come from them, but you can help guide them along the way.
We've now touched on the sort of the investment setup inside not-for-profit, so we might go down that stream for a bit. Obviously, in the last year, COVID downturn, sort of a bit over a year ago, a range of issues through bond markets, obviously fixed interest really low. What sort of pressures is that bringing? Because Greg, I think you made the comment about, they want maximise returns, but with their fiduciary responsibilities, they want sort of low risk. It must have been an interesting time for not-for-profits trying to work out what income they needed from their investments and so on over the last period. So interested, for Greg and Alex, what comments you made about what did you do with your not-for-profits? How did you run your portfolios?
If I could answer first, I would. Interesting. The COVID year last year was, well, every year we try and make a point of preparing forward income or forward return estimations, because they use that to go through their planning process in order to work out what projects or what commitments they can commit to. So interestingly, during the COVID year, when things went sideways for a while, it wasn't necessarily the capital base that they were particularly worried about. Of the few who were concerned, it was mostly about how we're going to fund these activities, because in a lot of cases, like I'm thinking one in particular, it's a medical endowment where they get most of their income from running conferences and what have you. And all of a sudden they realised that gone because they couldn't run the conferences. So they were looking back to their investment portfolio in order to fund their operations. So I would say they're much more sensitive to what is a sustainable level of drawing, more so than what the actual capital value is, because if they're looking at a very long-term time horizon, I think they can bear it out, but it's about the short term and their planning, which is important to them, I find.
Okay. Alex, you?
Yeah, so I think there's a couple of pieces to this from my perspective. I think, for organisations, liquidity management is really, really key. I think it's key for any client, but it's particularly important for organisations because they've got committed spending and they need to make sure that the liquidity is there to be able to meet that spending. So liquidity management is incredibly important. And again, it probably comes back to it comes back to the governance and that investment policy statement and making sure that the needs of the money that you're looking after are very well articulated, so that you've got everything covered. But liquidity for short-term, operating capital is particularly important. From a rates and income, low interest rates and income perspective, I think that's a challenge that everyone is facing, not just not-for-profits, but individuals are facing the same challenges there. And I mean, we've developed some specific solutions to try and address that, but you can't get anything for free. So unfortunately, you can't get more income and have no risk. We know where government bonds are trading, and you're going to have to invest in something else if you want to get more income, and you're going to be giving something up to get that. So there are those issues, and you've got to try and manage those. We've come up with some solutions to try and do that, and I'm sure other advisor groups are doing the same. One of the key differences, I think, that we find with not-for-profit clients when it comes to stressed markets like we went through last year, we actually find not-for-profits can be less emotional in their decision-making. And it comes back to that point, I guess, that it's not their money. So they are fiduciaries. I think being a fiduciary of the money does mean that there is greater appetite to avoid losses. But at the same time, there is less likelihood of becoming emotional about those losses. So we saw less propensity from not-for-profits to, lock in losses through COVID and kind of de-risk portfolios at the wrong time. We saw not-for-profits lower chance of doing that than individuals were. So we spent much more time holding the hands of individuals and families in the market downturn than we did for not-for-profits. Maybe part of it comes back to that investment policy statement, and they feel comfortable that, it's been well articulated what you're doing and just stick with that journey. But I think also part of it is that there's that less emotional attachment, which is a big differentiator for not-for-profits versus asset owners.
Greg, did you find you were pushed by some of the not-for-profits to try and generate more income in the environment? So, they still wanted income, but they still wanted no risk. Did you find you were getting pushed in that way?
I think this will echo what Alex has said. They're willing to take advice, and so it was more about aligning with what they've committed to versus what we can produce and what the consequences were. We didn't really have them trying to squeeze more income out, because we tried very carefully to, I guess, explain what the forward expectations were, and that we need to go through a period where we might be drawing less from the portfolio. And even now we're going through that process with, even though we're the other side of COVID, total return expectations for the next couple of years are very low. And so it's more about forewarning them to say the total return of your portfolio is going to be much less. If you've got an objective to beat inflation, you'll have to accept drawing less. Or if you've already committed to what you need to do, and you have agreement, you need to draw down some of the capital in the interim, then just be aware that's what you're doing. So, and generally they will take that advice. And so you wouldn't generally get a lot of pushback about any of the investment decisions, because as long as they're well thought through and logical and in keeping with the investment policy, generally the board or the voting members will agree.
Yeah, I'll jump in there. I think a couple of other differences worth pointing out. So Greg said they're advice takers, not for-profit organisations. It's when you're not the asset owner and you've got a fiduciary duty, but you've appointed an advisor to manage that pot of money, then when you're only acting in a fiduciary capability or capacity, you're going to take that advice of the advisor. So they really are advice takers, which I think ends up giving them a good outcome. I mean, most a lot of advisors would probably agree that where the individual asset owner is overriding the advice that they're getting is often when you get underperformance to that particular portfolio. So I think that is one of the key differences with not-for-profits, or a key benefit for not-for-profits is that they're very much advice takers. One of the other big things, and something that Greg's talked about, is it's budgeting. Budgeting is a big part of advising a not-for-profit organisation. So, ensuring they have the liquidity that they need. But we spend a lot more time with not-for-profits on that budgeting piece and giving them projections and detailed projections about the portfolio. And you can only obviously be as certain as you can be when markets looking into the future obviously are somewhat uncertain. But the budgeting piece is really important for not-for-profit organisations, and certainly much more so than for individuals.
Yeah, it leads me to a question that I have, in the fact that you both look after not-for-profits, but come from slightly different angles. Greg, you're obviously an advisor. Alex, Chief Investment Officer. So, Alex, do you have an advisor that sets strategy and does a lot of the relationship work, and then you come along and work on the portfolio? And Greg, do you do both, or do you bring a team in? How do you go about doing that when you've got different roles?
Yeah, so the way we do it is exactly how you've just described it. So we'll have an advisor who's the key relationship person with that client, and then I'll work with that advisor. He'll know, what the objectives are. He'll have worked with them on the investment policy statement. He'll know what's being achieved. From our perspective, he is the one that I will then work with to make sure that the portfolio matches the objectives that they're trying to get out of it.
It's similar for us. For a lot of the clients who I've had for a long time, I'd be the lead, and I might take an associate advisor with me. But when we're answering RFPs now, as part of the who is your team section, we would list the CIO and the head investment officer at Findex, and make it clear that the advisor is your relationship person, or the translator to what they need to what we can produce. And so I guess they want to see a little bit more under the bonnet as far as compared to your average client. They rarely would come to a meeting, but from our point of view, if someone was wanting to hear more from the investment side of the team, then I would request they attend the meeting, and so they could hear stuff from the horse's mouth. I'm lucky because I also sit on our investment committee, so I can pretty much say, but not as eloquently, what the investment philosophy is at any particular time. So I can sort of cross that bridge a little bit.
So we lost Greg there a bit, and he's just frozen there a bit. Alex?
Yeah, look, I can add to that. I think the way we think about it, the team approach works really, really well because you have different specialties between the advisors and someone in the investment team. So I think to be able to bring both of those specialties to the table, the advisor knows the client intimately and knows how to address what the client wants, and every client there are nuances in what every client wants, even though they might sort of notionally have the same risk appetite or whatever. There's always nuances between different clients, and so the advisor will be on top of those nuances, and the chief investment officer or someone else in the investment team will be on top of the nuances in the investment solution. And so I think when you do it as a team approach, you can match those nuances of the client and the investment solution together well to get the best outcome for the client.
Yeah. Welcome back, Greg. A little bit of technical issue. That's okay.
I dropped out. I wondered if one of your participants decided they'd heard enough of me.
yeah, just cut you out.
Yeah.
Alex, on that, what's sort of the size of the not-for-profits, and how many people sort of sit on their investment committees to run this sort of money? You got some examples?
Yeah, so in terms of people on it, we see anywhere between sort of 4 to 7 is sort of common, around that number. 5 to 6 is probably most common, but 4 to 7 at the extremes. And I think like any board, you know, if you have too many people sitting on it, it becomes unruly. So I think that mid-single digit sort of numbers is about the right number. In terms of dollars, they obviously range. But the ones we look after tend to be in the tens of millions of dollars, but they do range.
And Greg, can I ask you? We had a question from Monday, and hopefully our viewer from Monday is dialed in today, but asked about treating the directors as retail, wholesale. How do you go about looking after that in terms of that sort of retail wholesale split for directors of not-for-profits?
We generally treat all our clients as retail, and so we will treat the not-for-profits as retail at the moment. I know there's a higher bar for not-for-profits to be considered to be wholesale, but I guess we don't go down that line unless it's absolutely necessary. And so we'll take them through the normal retail process of providing advice. And one of the things which I think is absolutely critical is setting the risk profile for the not-for-profit, or the what risks they're prepared to take. So having that discussion, I think, is important, which you wouldn't necessarily have to do for a wholesale client. And often it ends up being a problem if you don't go through that process of setting risk parameters at the time when things aren't going quite so well. So while you can still have that discussion with a wholesale client, I'm sure that's fine. I'm just saying it's critical you do that, which you will do as a matter of course with retail clients.
And
sorry, can I jump in there, Greg? Because we've got a slightly different approach. It's similar, but different. I mean, as a business, we've got predominantly wholesale clients. We've only got very few retail clients across our business. And so our not-for-profits tend to be classified as wholesale clients, and which opens up some other investment options to them that are wholesale only, that aren't PDS. And so we prefer it when it's the case, partly because that's mostly what we're doing across our client base, but also because we think there are some great opportunities that are wholesale only in the investment space. But importantly, similar to Greg, the way we service our client base, we virtually service all our wholesale clients like they are retail in terms of the communication and the steps that you go through and are required to go through from a retail regulatory perspective. We really go through all of those steps anyway for all our wholesale clients, but because they're classified as wholesale, there are investment options available to them that are wholesale only. But we just think it's good practice to be dotting the I's and crossing the T's and communicating properly with all your clients and classifying risks correctly and all those sorts of things that you are required by regulation to do for retail clients. We would say that's just good practice. And so we kind of service most of our wholesale clients in that way anyway.
We've had a question come through about what's the best way to run a successful tender for NFP. So if you've got any tips, either of you, for how to get success in this space?
It's if I could start, it's a lot of work. I think the success rate with not-for-profits or corporations of winning the tenders is lower than your average client, because they'll generally go out to tender to a number of different parties, and so it's quite a lot of work putting sending the responses in time to the deadlines and making sure you answer all the questions that they've asked. Generally, all the clients who we look after has been by referral. So we're not searching, I guess, websites or looking for any organisations where you're effectively doing a cold response to an RFP. We'll tend to be requested to provide a tender, and after you've done a couple, you know pretty much the information that they want. But it is tricky because every different tender asks different questions, and so it's not as if you can use a template at SOA as you would do. I think the most critical part of that process is absolutely insisting that you have time talking to the decision makers beforehand, so you can actually scope out their problem, because often the written word's not going to give you the clear indication of what they actually want, and the written word often conflicts with when you go and speak to them what they actually want. So it's just like dealing with clients. You need to understand what they're not saying, but you need to go through that process. And it's also absolutely critical that you tailor it to what they need, and you get yourself an opportunity to get in front of the board so you can, I guess, show with some passion what your view and your plan is for that particular organisation. I wonder if Alex's process is the same, but that's the way we deal with it.
Yeah, I think from my perspective, the key thing to think about, which we've sort of touched on, but with not-for-profits, is it's very different to individuals because they're not the asset owner and they're doing a job. And so the difference then when you're pitching for this business becomes, in a personal capacity, a relationship and trust is a huge factor. In a professional capacity where they're fiduciaries of the money, it's probably less relationship. Trust is still clearly very important, but it's how is this person going to make my job as a board member easiest? And so with an organisation, what does that mean? It really means who is going to be the one who does the things like the budgeting, communicates with us, most clearly, easily, often as we want them to, really dots the I's and crosses the T's. And so I think something like diligence becomes, elevates in importance, and relationship is probably slightly lower in importance in winning that pitch. So to me, it's coming across as being all over things like helping them either draft or maintain the investment policy statement, the budgeting, and all those things that are less important for individuals, but very, very important for these organisations. And if you come across as being the person who's going to be the most helpful and provide the least risk to the board, then you're probably going to get the gig. It's probably less about returns and more about those other factors, and particularly for boards. Like the number one thing for any board is risk, minimising risk or appropriately minimising risk. So I think that becomes the key piece.
Can I add something? Sorry, can I add something else on the back of what Alex is saying? And this is not winning them, but once you won the client, I think Alex used the word, make their job easy. And so knowing when they've got to put their board papers together, making sure you've got the up-to-date reports that they can go in there, knowing when you need to, often they'll be meeting on a weekend, going in and presenting to the risk and audit committee or whoever's running the investment piece, being aware of that and being prepared, but also knowing when they're doing their annual projections and calculations, and being attentive and making sure you've got the information to them. Because if you can make their job easy and you're synchronized with what they're doing, they're very appreciative.
Yeah.
I think, can I just jump in there? I mean, because there's lots of people interested in the not-for-profit space as an attractive space to win clients, and we think it is. We like serving not-for-profit clients. There are differences. You spend less time on the relationship piece and less time holding hands in difficult market and those sorts of things, but absolutely more time on administration and those things that we've talked about. So, I would say that they are no less intensive as a client, but it's a very different service and very different things that you spend the time on with them.
Good. Now's probably a good time actually with talking about tender process, because I'm sure boards would ask you about fees. So I'm interested to know how you both go around your fee charging in not-for-profits.
I'll let Alex go first this time. I feel like
Sure. Look, for us, it's a commercial arrangement. So that they are not dissimilar to fees that we're charging other, individuals and high net worth individuals and families. We have a sliding scale, so the bigger the client is, the less percentage it is of FUM, and so because they're reasonable sized clients, they're getting a fair fee, but it is a commercial arrangement.
And Alex, your percentage based fee on size of assets?
We do have some clients that are on fixed fee at the larger end. The not-for-profits tend to be a percentage is not fixed fees, but we do have some families on fixed fees. Yeah.
Greg?
It's arranged for us. I have a personal policy of trying to discount my time because in keeping with the nature of the organisation, so I would often waive the advice fee. But the way we charge is a flat advice fee and a percentage portfolio and construction and management fee. And so generally they would be charged that percentage fee. On occasions, that's then converted into a flat dollar fee, depending on what their preference is. But generally, it's a percentage fee, and generally it's slightly lower than an individual's fee, just because I'm treating part of that fee as a pro bono action.
Right. Okay. And how do you find not-for-profits in challenging fees? Is it a pushback? Have they got understanding in the market? What's their approach?
If I'm going to answer that quickly, they'll know by the tender process, because they'll generally have 3 or 4 organisations tender to them, and so they'll get a sense of what the different organisations are charging. I don't think they will get hung up necessarily on fees, but they'll have a very good idea of what the range is. So if you're like massively overcharging, that's going to come out straight away, and so you just won't win the tender. You won't know why. Or if you're undercharging, they might then question, well, why are you so cheap? These guys must be better because they're charging us more. So it's a bit of a mixed bag.
Yeah, look, I agree with that. We as an organisation just always try to price sensibly, and if anything, I think we're probably slightly low in the market rather than high, and I think we provide a good service. Hopefully most people would say something similar. I think if you're sensible about it, then it's not going to be a point of differentiation for you when you're pitching for that business. You just have to be realistic in what your service is worth, and then price appropriately. To us, pricing just shouldn't be either where we win business or where we lose business if we're pricing correctly, and that's I guess how we try and think about it. We'd much rather win business on good service and be priced very, very fair for both parties. But that's just how we think about it.
Okay. I want to go a little bit deeper in one particular area, and it relates to probably most clients today, but certainly not for profits, and that's this. I think you both sort of mentioned ESG and ethical investments. So how are you finding that coming up? What are boards saying about that? What are they asking now that maybe they weren't asking 3 or 5 years ago? Interested in how you're dealing with that? Greg, we can
go. Oh, you go, Greg.
I was going to wait again, let you go. I would say the not-for-profit space is much more interested in ESG and SRI than your individual clients. And it's been growing, I would say, in the last 4 or 5 years. And so that's certainly they're leading that push about demanding SRI ESG options. So much so that when we go through developing an investment policy for these clients now, one of the key questions we ask is what investments do you want to exclude, either an SRI option, or there could be investments which are contrary to their sort of the philosophy for their not-for-profit. So it's a really important step. And I think it comes back to what Alex has said a couple of times, because it's not the money, their money, the decision makers, and they're taking their fiduciary responsibilities seriously, that they tend to have more of an inclination to want to also add in that ESG and SRI. So I find that they push, they lead as far as my client base is concerned, that thinking.
Thanks.
Yeah, I think it's something that needs to be included in the upfront work when you're putting together the investment policy statement. We would normally encourage them to also have an ethical investment policy, or at least consider whether they should have one. And a lot of organisations would decide to do that, and particularly to align that policy with the beliefs and culture of the organisation. And that, I think that's really important for organisations, because you don't want it to be in the AFR that such and such organisation has exposure to whatever it is, that it's completely against the beliefs of the organisation. So I think it's something that's really, really important to have, and it's something that's important to articulate up front and have a clear policy on.
Yeah. With only a couple of minutes to go, I was just wondering, is there any sort of final points that either of you wanted to make about, being successful in this market, what not-for-profits are really looking for? Is there any sort of summary points you wanted to make to people on the webinar? Alex, you want to go first?
Yeah, I'll go first. I mean, I'll just reiterate, a couple of those points. To me, the biggest thing is you're advising fiduciaries of money. They're not the actual asset owner, and so that's the key difference. And if you're aware of that key difference and the requirements that holds, then I think you're going to be doing a good job by them, or winning a pitch to get that business, because you're pitching in that different way that's appropriate. It's like with any client, you always need to advise the client in a way that is appropriate for them, and it's no different with not-for-profits. There are just some specifics around not-for-profits that are appropriate for them, that are different to individuals and families.
Yeah, I agree 100%. I think the key thing, the first thing is, I think not-for-profits are a funny one, because one gets you two and two gets you three, because you'll generally get referred the clients, because a lot of the time the CEOs of the organisation sit on several not-for-profits, and so they tend to be your best advocates to be referred new ones, and they'll often go off to conferences, and so they'll sit around and talk about who they're using for their investments, and if they're happy, then often you'll be referred clients that way. But then it's a hard slog. You've got to go through that process, and I think Alex hit the nail on the head. It's less personal, and it's more professional, a professional process, and I think it's easy to intuitively come up with the goals and objectives for individuals, but you really do need to do a very deliberate process to go through and develop an investment policy. I think we've banged on that enough, but I think that's the absolute critical part. But also the part is really understanding what they're trying to do to make sure that's tailored properly, but then explaining to them what they're asking you to do. So you've got to go back to them and say, well, this is what you asked me to do. This is how we're going to do it. Is everyone okay with that? And do you know this means you're taking this amount of risk? And so there's much more communication required on a professional level, because they won't really, like individuals, ask you questions about this and that. They'll just be mute unless you ask the right questions, particularly in the board sessions. And that's what I see is one of the key differences.
Right. Alex, Greg, thank you very much for your participation today. It was really good. A lot of great information to that, and we could have gone on for a lot longer, but time is upon us. So thanks for your input. We really appreciate your experience and wisdom coming into the topic. Thanks, Toby.
Thank you very much. Thank you very much, Greg, Alex, and Greg. Greg, incidentally, is coming to us today from a day's break from his holidays. So we're particularly grateful for his time. So just a reminder, this Friday, trying to draw these threads together around what is a strategy that enables an advice business to build in this space. And then for May, our advisor roadshow. So thank you very much, and we look forward to you all joining us again in a couple of days' time. Thanks very much, guys.